This panel of planned chief investment officers will explore the various investment and policy issues affecting public pensions today. The panelists will share their views on current events as well as thematic issues such as macroeconomic trends, the outlook for investment performance, management risk, and investment fees. Please welcome Scott Evans, Jonathan Grabel, and Farouki Majeed.
Good morning, everyone. So I'm very pleased to have this panel joining us this morning and to share some thoughts about the outlook for public plans in 2018. Before we go around the panel and have them introduce themselves, what I want to also do is allow you a chance to participate and contribute to this conversation. So we have a number of topics that we've prepared and that we will be discussing, but to the extent that we can make this a conversation amongst all of us, we would certainly like to have that. So somewhere during the middle of our presentation, we will have folks with mics, so feel free to ask questions through that, the traditional means, or if you want to participate in a more discreet and maybe in the 21st century model, we do have our app. And in the app, there is a messaging function. And please feel free to send me a question that you would like to ask of our distinguished panel. So I'll have my phone up. I'll be looking at it every once in a while. It's not to ignore the panelists or to ignore you. I'm just trying to see if you sent us any questions. So with that, let me give each of the panelists a short minute to introduce themselves. And Scott, this is your town. Why don't you go first?
Sure. My name's Scott Evans. I work for Scott Stringer, who you just heard from, and I'm the Chief Investment Officer for the New York City retirement system. And that it consists of 5 different systems, one for teachers, one for general city workers, one for police, one for fire, one for the Board of Education. We have 58 trustees in all, including Scott Stringer, and we work for them, and we work for the 715,000 workers in the city of New York. The fund today is a little under $200 billion, and you know, we keep our fingers crossed that as economy continues on. We'll talk more about that.
Farouki?
Yep. Good morning. Great to be here with you all this morning. I'm the CIO for the Ohio School Employees Retirement System. So we are about a $14.5 billion fund, sort of a mid-sized fund. It's fun running a fund of this size as opposed to one that is something like 200. I came from CalPERS in my prior job. It's a much more difficult job trying to steer a super tanker, particularly, you know, in changing types of economic situations. So I'm greatly enjoying this. I'm wonderful to be here. And I have 3 of my trustees, so hopefully I do a good job on this panel. And thank you, Hank, for having us over here this morning.
You're welcome. And Jonathan, you traveled the furthest, and so you get the last word in terms of the introduction.
Thanks, Hank. Good morning, everyone. Thanks for having me here. I am John Grabel. I'm the Chief Investment Officer for LA County. We oversee about $55 billion on behalf of 160,000 active and retired members. We also oversee about a $1 billion trust for OPEB benefits. And I also have some trustees in the audience. And what I will say unequivocally is that the Lacera trustees are the best looking in the room.
All right, well, so let's get to the meat of the conversation. So in terms of each one of your individual plans, how would you characterize your plan's investment beliefs? Farouki, let me start with you.
Yeah, I really believe that having a formal set of investment beliefs that the board and the staff have agreed on and put on paper is one of the better things that you can have in your governance. So when I became CIO of Ohio CERS 5 years ago, That was one of the first things that we did, was to have some extensive discussions with the board and ourselves and the consultants to agree on a set of investment beliefs, which will be the sort of compass or the guidepost for the investment strategies and constructing the investment program and managing it. So we have, they can be broadly classified into a couple of different areas broadly. One is what are our views about the markets? Some people have different beliefs about how markets behave and therefore how we should be interacting with markets. And that relates to something such as active and passive, as well as risks and so on. Secondly, it's in terms of the governance aspects of the fund, which I think is very crucial. I think in terms of who makes what decisions and who is responsible for what aspects of the investment program is something that we agreed on as well in terms of our investment program. And I'm really happy here that our board has been very proactive in terms of that aspect of it and delegating certain key investment decisions to the staff and holding staff accountable. And some of the other aspects are what the controller spoke about in terms of environmental, social, and other types of issues as well. So it is good to have these things kind of set in place so that we know how we operate relative to those beliefs.
Great.
And it's good to kind of check them now and then to see whether your beliefs are sound as well. Thank you.
Sure. And then, Jonathan, anything to add or elaborate on?
We too have something that's codified, a statement of investment beliefs. I think it really is an essential governance document. In addition to what Farouki mentioned, ours includes things, which I'm sure theirs does also, about liquidity, active versus passive, fees, expenses, and a duty to continuously be educated as to new developments. But it's a really good document to have, especially as you go through market cycles, to go back to what your core beliefs are.
And Scott, so the question to you in a slightly different way is, Farouki touched upon how, the period of review, how often do you do that? And particularly since you have 5 boards, do you have one single policy beliefs or is there 5 different?
We have at least 5 different. So we have 5 different systems, and they think and behave independently with regard to all issues. But we meet together, and it's a collegial group. Many of them are in this room from different systems. And so while there are differences, they rhyme when you look at them. We do not have formalized, codified investment beliefs in our investment policy statements. However, I believe that there's certainly several boards that believe this is a best practice and are working on them today. That being said, there's no absence of a robust discussion from the boards to the investment advisor or our Bureau of Asset Management about what those beliefs are and how they should be carried out in practice. And so I think the practice is very robust, but we're in the process of codifying.
Right. So let's move on to our next topic, which is sort of how to balance inherent conflicts. And I'll start with you, Jonathan. So the concept here is that funds always want to be in the top performing quartile, but they are, I guess, we are fairly conservative in our thinking and don't necessarily want to be in the early adopters of certain strategies. So how do you at Lucera balance some of these inherent conflicts?
That's a great question, and I'm saying it's a great question to buy myself a little time. In that, I think to take a step back, the real challenge is, many of us, and we go to board meetings, we have, staff, you have advisors, you have money managers, tell you that we're in a low expected return environment. And given that this has been a great decade for returns, but if you think about what may be next, those returns may be harder to come by. Thereby, those inherent conflicts, really become more important to ferret out and to resolve and to push forward. Now, as it relates to answering the question, which I'll do at some point, I think it is important to have investment beliefs, which gets you through some of those implicit tensions. So one way Lacera does it is by having a statement of investment beliefs. Another way that we have it is we look at performance in multiple dimensions, not just returns, not just historical returns, but we look at many of the implicit risks, including liquidity. We look at every decision hopefully being a more intentional decision, such that we don't have 10 managers doing 10 different things and counteracting one another. So it really is a challenging thing, and maybe the ultimate answer is we have to go back to what our mission is. Our mission is to pay benefits today and into the future. The ultimate goal isn't just to generate returns and the best returns and being top quartile such that we feel really good about ourselves. So I think that the answer is a combination of having core beliefs, to discussing those in an open and frank framework, but also understanding why you're investing.
How about you, Scott? Is the calculus slightly different for you in being such a mega plan with assets nearly $200 billion?
No, I think as an asset allocator, as a manager of a large institutional pool of capital, particularly a pool of pension capital, the mission's the same. The number of zeros may be different. The constituency of the structure may be different, but it's the same job. John said it. The way you deal with conflicts is to focus on what the common goal is that you have. Our goal is not to produce league-leading returns, top quartile results. That's not our job. Our job is to meet the promises that we've made, in our case, New York City, to our workers that will provide for their pensions. We've set aside money, and it's our job to use that money to meet those obligations. Nothing else matters. And we have to do whatever we can to stay focused on that mission together, despite, and there are conflicts, there are distractions in any business, and there are lots of them in this business. But if you stay true to that and stay focused on it, as our trustees definitely do, then you have minimal risk of having the conflicts and the distractions take you in a misdirection.
Farouki, how about you from Ohio?
Yeah, so appreciating the prior comments, I'll probably try to frame this a little in a different way. So we can look at it, say, for example, this thing stands on 3 legs, this tool. So you have the board, you have staff, you have consultants and managers, the external entities. And I think it's very important to manage these 3 legs of the stool. They need to be symmetric in the sense that they are staffed with good competencies on all 3 sides. As someone said, if any one of them at any point in time is weaker than the other, the stool is going to wobble. So the other thing I think is to think about who really is driving the bus. So I'm the CIO. The way I think about it is I'm driving the bus in the sense that I've got to make decisions on a day-to-day basis, given the parameters and the goals and standards that the board has set. But at any given point in time, I'm responsible for delivering the kind of results and the expectations that the board has. So I think it's a good thing also for the board to think about who exactly is driving the bus. And sometimes conflicts can come from consultants, external managers, and staff, and so on and so forth. So this needs to be fairly evenly balanced. Otherwise, you will find that sometimes the external entities are really driving the bus as opposed to the staff, and so on and so forth. So that's something that is a good thing to pay attention to, because you can only hold someone accountable if they have the responsibility to do what they're being tasked to do. So I think, generally speaking, those are some of the tensions that we have
Right.
in the way we are trying to run our plans.
So let's continue with this theme about sort of tension. And certainly, public pensions are loath to, we hate high fees. Yet at the same time, when we do talk about bringing resources in-house, just as public entities, we cringe at the notion of paying sort of, high compensation and benefits to the investment staff. So, in terms of sort of internal management and in-house resources, how do we, sort of work out the conflict there? Scott, let me start with you.
We work out the conflict by outsourcing all of our management to external managers. I think with our structure and the way we're set up, that makes sense. It makes us unambiguously focused on hiring good stewards for external managers, for contracting with them in a way that they're well aligned with the interests of our beneficiaries. And there's no sort of staff external manager conflict, which can be an issue. If you do go internal, you have to be convinced that at the end, for the amount of money that the city or municipality puts in place, there's going to be more results at the end for any given level of risk for doing internal management versus external management. And there are a lot of variables in that. It is not unambiguously clear that using internal management is going to get you to a better place long term. There are a lot of assumptions that have to be met in order for that to happen. There's no question about the fact that you can pay less to the factors of production to an internal staff than you get to the external staff. But what you really need to be focused on is not the paycheck, but what are the returns that you're getting for the investments that you're making, net of fees. And that's the analysis that needs to be made.
How about you, Farouki? What are your thoughts about internal resources?
So, having worked at both large plans where we've had a lot of internal management, for example, at CalPERS, 80% or so of the funds are managed internally, all equities, all fixed income, and so forth. So I'm here at a smaller fund. It's 100% externally managed. You've got to make that calculation in terms of what it is that you're willing to invest with relative to staff and compensation, but also you have to have the scale for doing it. So for a period of time, for example, at my fund, we had appointed director on the board who came from an insurance company and wanted to ask the question, why aren't we managing part of our portfolio internally, particularly the bonds and so on. So we did some analysis and presented the case to the board that we really didn't have the scale. And the other thing is, what is your goal? Are you just trying to reduce fees? So our investment statement, investment belief statement as far as fees go is we say costs matter, but what really matters is net of fee returns. So in other words, we got to figure out, if we think that fixed income, for example, our net cost is about 20 basis points, but if we can generate excess returns using our external managers who have specialties in areas that we cannot, for example, do, such as high-yield bonds and emerging market debt and various things like that, it's very complex to put a team together that can do all parts of a fixed income program. So, I think what we demonstrated is that for the fee that we're paying, we're able to generate excess returns that are much higher than what we think we could earn by doing it internally and having a cost maybe that is 5 basis points instead of 20 basis points. because the margin of excess returns is much higher than what we could earn by managing it internally. So I think that's the kind of calculation that we've made.
Jonathan, your thoughts?
And I think there are a couple issues being discussed. I think first is, why would you want to manage assets internally? We manage them externally like the other two plans. And I think the reason to do it is not for staff ego or board ego that, hey, we manage, assets internally. Because in many cases, those assets that you do choose to manage internally are a commodity. It's pushing a button, following software that you get from, a third-party provider. To the extent you want to either build a culture of investment and accountability, which may be one of the softer reasons to bring assets internally, you have to ask what type of assets and where your edge is. If they're efficient assets, do you have better technology than a BlackRock, for example? If it's a less efficient asset category that may be more a private asset, do you have access to better information? So I think that you have to fundamentally answer those questions about the external versus internal and figure out where there is that best net return that's been referenced a couple of times. One other point that I think is important for us as representatives of internal teams is we have to be sensitive to the plans and the membership that to pay Wall Street type salaries, if the average public employee is making X dollars and you want to pay your staff 10X, 20X, I think that's something that may be difficult, especially when that employee in a public plan has all the kind of downside protection. When you work for a money management firm, every day you show up, in many ways, your job's at risk. You have to perform. If you work for a public pension, you have a lot of, not guaranteed employment, but it's a lot safer. The hours are a lot better, and you have a pension. So I think that it's really important to understand that the totality of that employment relationship, and not just say, pay me more and I'm going to do X. If you want to pay me more, you have to expect more from me and from the team.
Scott, Scott, let Scott go, and then
John said something that's really important in this dynamic that I just want to reemphasize about internal management. And so before I was here, I came from a place, TIA, where we did almost exclusively internal management and faced some of the issues that large public funds face when trying to internalize. When we hire managers, when we hire external managers, we look for a lot of things, but there are two really important things. One is a culture of independent thinking and independent decision-making. It's one of the reasons, Scott Stringer mentioned it, that we look for diversity. We look for diversity in decision-making, and it's part of our due diligence process. But there has to be a real culture of meritocracy and independent thinking. And that can only happen in an environment of accountability, where you're giving someone the discretion to make decisions and they feel accountable and they're going to strive for those results. Now, we often focus on the compensation schemes and how we can pay less. The compensation scheme that comes along with the culture of a place that has independent thinking, meritocracy, and accountability necessarily comes with performance compensation, where you've aligned the interests of the client with the interest of the beneficiary. And so whether we are building this externally, and it's easier to find this culture externally than it is to build internally inside a large institution that's made up of employees who have a different deal in terms of their financial deal with the city, with the state, with the institution. And so building these delicate, strong investment management organizations within the confines of a large institution is a lot harder than it looks on paper. And so if you go into this, the board, the investment management subsidiary, the consultants, if any, really have to be willing to almost create an independent, separate group that has the same kind of rules and structures that the external managers do. And so that is a really important consideration. If you set up an investment firm internally that doesn't have that, its chances of success are much, much lower.
Farouki, you had
Yeah,
some thoughts?
the only thing I wanted to add to this is that whether you manage externally or internally, I think the competence of the internal staff has to be the same. Because in the final analysis, what the board is looking for is your performance against your benchmark net of fees. So if you're able to consistently add value and meet the board's whatever target you have for excess returns over your benchmark, whether you do that externally or internally doesn't really matter in the final equation if you're able to meet those targets. And to be able to do that, it's my belief, having worked in both types of situations, that the level of competence that you need in the staff is the same. Because you got to approach this, you got to make investment selection decisions, whether you're selecting a stock or whether you're selecting a manager, the process is basically the same. So that's the point that I wanted to add.
Great, thank you. So we're about 20 minutes in, or actually I should restate that we have about 20 more minutes left in this session. Again, we want to make this as interactive as possible. So if you have any questions that you would like to ask of the panelists, please either, again, raise your hand and we'll have a mic brought to you. Or again, if you can certainly use the app that we have and send me a question that way. So let me pause here for a second to see if there are any questions. Otherwise, we'll continue with our next set of questions. Okay, all right, well, so then Jonathan, let me turn it over to you. So I think it's fairly well-established conventional wisdom that we're in a more volatile economic period. What's Lucera doing to take advantage or protect yourself in this volatile state?
And I think it's clear that nobody knows what's going to happen tomorrow. I think anybody that tells you at this conference or any other event who knows that, invest with them and they'll get you through, just run, don't listen to them. Nobody knows what's going to happen. I think what we're doing, and I think that many other plans are doing, is we've all benefited over, since the great financial crisis from a, really strong performance. And I think that a couple of things. One is many plans haven't necessarily rebalanced to target, and rebalancing to me is the most prudent form of risk management because you adhere to your strategic asset allocation and you choose that for a reason. So I think now is a time to rebalance and to best diversify your risks across asset categories. I think that there's too much focus on diversification within asset categories and fine-tuning for the latest and greatest innovation in pick your asset category. As it relates to Lucera, last week the board approved a new strategic asset allocation, which I believe and the board believes better diversifies risks holistically across more asset categories. So we've introduced some new strategies that potentially can diversify away from the most significant form of risk, which is equity market risk in the portfolio. Something else that I think may be helpful in an environment like this where markets have run for better part of a decade is to go back to the investment beliefs that we spoke about earlier, be it codified or not, and identify where your kind of bull market excesses are. Go back to, be it asset allocation, be it a focus on proper liquidity management, on risk balancing, on looking at benchmarks, and to the extent you stray from those core beliefs and drivers of returns and what fundamentally your mission is, look at those and address them.
Farouki, you know what's going to happen tomorrow, don't you?
If I knew, I'd be running my own hedge fund. Even they don't quite know, right? That we know that. So yeah, I mean that's the interesting part of this business, which is fascinating, is that you're always operating in an uncertain environment. How do you make decisions with conviction when you're operating in an uncertain environment? And that's what we all try to do. You're working with probabilities. So I think one of the more immediate things that we have is to anticipate the next downturn. When would that be? 2019, 2020, and so on, what some people say. I think but we are, we will make some slight changes. We are not making huge changes to our asset allocation, but in the overall direction, the way I'm thinking myself about the evolving nature of the markets is, I think there's some significant things to think about. So we've had a 30-year period where interest rates have been steadily declining. So it's a secular decline of interest rates from the 1980s all the way up to a few years ago. The 10-year yield has come down from something like 15% to as low as 1.6. And now it is headed slightly up from there, and maybe now it's at about trying to hit the 3% mark. So here I think we have, in my view, have an inflection point, and that interest rates will not be any lower than 1.6, I think, going forward. Interest rates are trending up. They may not go up at a steep pace. They may be range-bound, but whatever it is, that long-term decline in interest rates is over. So we have a different environment when we are looking, I think, forward. So this has some implications for correlations of assets, equities and bonds and so forth that we are trying to think about. The other is that volatility, which has been very low over the last several years, is now bound to go up. So you should expect that, and I think we're seeing that already. And valuations are very high. When valuations are very high, that means risk is high. Going forward, returns are low. The margin of safety that you have at these valuations is not that great. So you probably don't want to take the same level of risk that you had taken over the past several years in order to get the very healthy returns that we have. Our fund has about a 9% return over the 5-year period, and that's going to be hard to achieve over the next 5 years. And one of the things that we are focused on is to try to minimize the downside as much as possible, or try to manage the downside as much as possible. And so that's something that we are thinking about.
Great. And then last word on this topic to you, Scott, but just slightly in a different format maybe. So if we are, in fact, in a volatile period,
You're going to increase the degree of difficulty?
yeah. So, well, you are the hometown CIO,
okay,
so we
go
can't
ahead,
throw
Ed.
you a
Go
softball
ahead.
all the time, right? So, what are the pros and the cons of active versus passive
Oh,
management?
active versus passive? I think that with active versus passive, you have to think a lot about what the advantages are of each. With passive investing, you know that over long periods of time, you're going to get pretty predictable results. You can invest very cheaply, have a very small staff, and invest adequately and defease your pension liabilities with a 65% of the portfolio in equities, indexed equities, and 35%, 40% in fixed income securities. And you can do that not for free, but pretty close. And you can do that with almost no staff. So that basic premise is basic premise should be, why should we differ from that? That will get us to where we want to go. There'll be risk involved. How can we make that better? And only if you have a way to make that better should you contemplate other asset classes, active management. There you want to look at the odds of success. You want to look at the cost of deploying active management. And as we've all done this over time, we have constructed portfolios that do look different than that 60-40, 65-35 index portfolio. We've been able to get the same expected returns with a little lower volatility. And we do that because we're investing in funds, many of them active funds, that go up and down at different times than the basic stock and bond part of the portfolio, alternative assets, active assets. And so that's the basic philosophy that one should use. How do you look at it now that we're in sort of dangerous valuation levels? Farouki mentioned it. We are at extremely high prices for equities. We're at extremely high prices for bonds in an absolute sense, as Farouki mentioned, and also in a relative sense. When you take risk on bonds, you take credit risk, be it in investment-grade bonds or even high-yield bonds. We're not getting paid much of a premium for that. But we want to, over time, invest in assets that will go up and down at different times. In the public equity space, the past 5 to 10 years has not been good for active management. Active management tends to do well when markets are going down because active management vendors tend to hold a little bit of cash. They tend to invest more broadly across the market. They'll have less in the Googles and Facebooks. And so when markets go down and valuations compress, they will look good in comparison. So I think it's not a bad time to be evaluating whether there are good long-term active managers that could be part of the mix, but you have to be very careful to make sure that you think you're going to get a return for the extra costs that you deploy when you hire them.
Right. So we did get a number of questions. So we've got about 9 minutes, so we'll enter the lightning round of this panel discussion. So given the position or the thoughts expressed by the panelists regarding internal versus external management, how do you, folks on the panel, how do you view the Canadian model and the success that they've had with internal management? Who wants to start? Go ahead.
A couple thoughts are, first, once again, I may not be an expert on how all of the Canadian plans run, but they have two advantages. One is that they're less mature and they're not cash flow negative in the sense like many U.S. public pension plans are. And I think that there's a huge advantage associated with that freedom. The second is not all of those plans and the internal active management associated with private equity, infrastructure has weathered a cycle. So to the extent that on the up, it's fantastic. Everybody wins, but until you've lost money, investing is really easy. And I'm curious to see how many of those plans weather the next cycle, especially if it's a deep cycle.
Anyone else?
Yeah, I've followed the Canadian plans for a long time. From my days at TI, spent a lot of time with Claude Lamoureux, who built the original Canadian plan in Ontario Teachers, Dave Dennison that built CPPIB. They started by, their objective was to create the type of internal culture of independence and excellence that we were talking about. And I think Ontario Teachers, CPPIB, and the like are a legitimate effort to sort of put all focus on that. And when Dave started out with CPPIB, they were very selective of the assets that they would try to do themselves. As I recall, it was real estate and infrastructure were the first two. Everything else was indexed. They've evolved since then, and they now have like 1,500 employees. It's really become a huge operation. Most of those people are in their real estate operations. But I think it's a legitimate attempt to go all in on the concept of internal management. But it starts to get complicated, as John was referring to, when you look at the liability structure. Canadian pension plan has a very, very long tail, very long duration. Ontario teachers, a little bit more mature, like we are in the U.S., but their governance structure is quite different. I don't think, how many presentations on the Canadian model have we all sat through? And I've kind of gotten sick of it, and I stand up and I say, we're not going to become Canadian. We need an American model. We have a structure in our funds that are representative boards. Most of us in the U.S. have representative boards. And so you have to try to address the same things that the Canadians were trying to do if you want to go into internal management. But you have to do it in a way that's compatible with our board structure, our beliefs, our liability structure. And so you want to look at the important elements of the Canadian plan, but we can't copy it. It doesn't make sense to, for most of us.
Thank you. All right, another question is, what's the panelists' approach to risk management? Have you considered adopting a risk budget? How do you report on funds' risk exposure to your boards? Farouki, do you want to start?
So, so this is one of the things we've done in our fund. Risk management has become a new focus for us. So I'm thankful that our board was able to approve a budget for us to acquire a risk system that we have implemented internally. That helps us two ways. One is to communicate with our board on the higher level aspects of the risks in the fund, as well as for our own internal management decisions. So many of my staff who, some of them were skeptical at the point when we were trying to do this, now really appreciate that it provides them with some information and insights that helps them to better make investment decisions and to better understand the impact of the decisions that they make on the total fund. So it's the other aspect is communicating about risk is sometimes, particularly with the board, can become a little difficult if you get too much in the weeds, because you're talking a lot about numbers and jargon and so forth. So we kind of keep our communication with the board at a very high level. What is the risk of the total fund in terms of expected wall relative to what was assumed in the asset allocation? How is it changing? The other one is what level of active risk are we taking in order to generate the excess returns, and so on and so forth. So, and then we have some scenario analysis, for example, in terms of what could happen if interest rates blew out on the upside, for example, or inflation or oil prices and so forth went back up to $100 or $150. What would be the impact of the portfolio? So these are things that gives board some sense of the varieties of impact on risk.
Okay, so Jonathan and then Scott.
And quickly, a couple things to add are, I think staffs may like the various risk metrics more than boards do, having seen it in a couple of places. It's pretty wonky, and so I think the challenge really is one of communication. But I think that risk management truly is essential, especially if what we're in is a higher volatility, lower expected return environment. The one other aspect of risk management that I think is essential is manager proliferation. To the extent you have an unintentional portfolio that manager A is doing something different than B, and they're counteracting each other, and then you multiply that by 50, I think that is a key aspect of risk management that really needs to be looked at and make sure that every decision is an intentional one.
Scott.
These guys have touched on a lot, so I'll try to be brief. Risk management, the quest with risk management is understanding the behavior of the portfolio better. So we make a lot of assumptions. We come with a consultant, we do strategic asset allocation, and we'll assume the behavior of different asset classes with each other. And we give an expected return, expected volatility, and a couple other dimensions. And that's what we expect over time. It's extremely high level. But if you ask the question, well, how's the actual portfolio that we have in place doing, and what are the risks that are being taken? And if I use some mathematical models, how different would it see the current portfolio versus this kind of hypothetical that we have? And that's what risk management attempts to do, both for the people who are looking at it closely and for the board members. So we should, to these guys' point, we should be able to talk at any level about this and talk about it in plain English, as well as all the wonky technical talk that we need to talk to the managers. But to have a good risk system, you absolutely must have one thing. You must have good data. And one of the things that we all struggle with as we're implementing these systems is getting the data aligned properly from the custodian, from the managers, getting everything in a common format, and being able to analyze it so that you have good data and not noise. And that takes a long time, a frustratingly long time. I can tell you our trustees are frustrated. We're frustrated with how long it's taken, even though we selected a vendor a while ago. But if you have garbage in, you get garbage out. And so you must make sure that the data is good before you start trying to analyze it, because if you're analyzing noise, it could lead to really bad decisions.
Ladies and gentlemen, unfortunately, we are out of time. And to the folks who submitted questions, I'm sorry we haven't had a chance to get to them. Hopefully, we can find another venue to reconvene and address some of these other questions that are outstanding. But in the meantime, let me close by, again, thanking the panelists, thanking you all for being here today. Thank you so much to Scott Evans, Farouki, Majeed, and Jonathan Grabel.